Hello, this is Brian Shannon from Alpha Trends Blogspot. It is Monday, the 19th of November, 2007, and we're going to go ahead and take a look at these Nasdaq big cap leaders once again that we looked at about 2 weeks ago. 2 weeks ago, when I had put a video on, I think the stock was right around maybe this level right here. And I was thinking that it looked like the stock was probably headed for a test of the 50-day moving average, as that was, actually it was about 610. And I thought that it was also a good reason to expect for potential resistance because it was also the level of a 50% Fibonacci retracement from the August lows to the just recent highs here. You can see that it has come down, tested that 50-day moving average, in fact, twice in the, today and on Friday, and it seems to be holding above the 50-day moving average as well. What I had cautioned back then was that these 50-day moving averages often act as support, but that's not a reason to make a purchase there. The only reason to make a purchase of any stock out there is because of price action and price confirmation that it is actually a level of support. So when we look at a 50-day moving average, what we want to do is not use it as a trading system, but just as a reference point, something to compare price to that gives us some objectivity, because what typically happens is the people who've been selling up at 720, 710, 680, 670, etc., start to see the stock coming into that 50-day moving average, and they start thinking, well, the 50-day moving average usually acts as support, therefore I'm going to stop selling so aggressively. You've got other groups of participants that start looking at it as a potential support level and stick their bids in there. Well, that reduced supply and increased demand in that area often does lead to a turning point. It doesn't mean it will, and these technical tools are only good for giving us an indication of a potential scenario, nothing more. Like I've been pointing out on my blog too, we've had this MACD that is diverging. The MACD is a moving average convergence divergence oscillator. There's a video on the side of my blog that explains that a little bit further and how to use the divergence. But if you look at the stock right now, you can see what's happening is that the stock made lower lows while the MACD here was making higher lows. That's a divergence, meaning that the stock is showing strength, but basically it's not declining as rapidly, and that often occurs near turning points. Now, when we drill down a little bit further to a 10-day time frame rather, each one of these candles represents 10 minutes worth of data. You can still see the scope of this sell-off, and you can see that actually the recent decline retraced up to 38.2%, and Fibonacci is just the same as a moving average or any other technical tool. It gives us a way to define some what appears to be random market activity and to apply some basis for our timing and try to make some order out of what appears to be chaos. Now, this 5-day moving average is the orangish moving average here. And basically, you don't want to be buying the stock as long as the stock is below it and it is continuing to decline. You can see that maybe it's starting to flatten out as the momentum seems to have slowed down in here recently. But I think it's going to take a move probably above at least this 638 to 640 level. What I'd really like to see happen would for it to be to rally up to that level, pull back, make a higher low, and then break out. And even if it breaks out, it might not be too late. Now, my pen doesn't let me draw over there, so I'm going to say if it breaks out, you might see a pullback before it does then begin a rally that might sustain itself. And then you would begin to apply Fibonacci once again to say, where's the potential for resistance? Well, maybe it would make a 38.2% retracement of this move. Well, if so, that would bring the stock up to about $667 a share. Looking at the daily time frame, you can see that's approximately where we have the 10 and 20-day moving averages as well, often at a place where you find resistance like you did here on that last rally. So there's still a lot of mixed signals. Google is a high-risk stock. Perhaps it's ready to turn in here, but don't be buying blindly into this. Let the institutions accumulate the tens and hundreds of millions of shares in here that trade each day, and let them do the dirty work of ridding the sellers from this market and creating a solid base of support. But if this stock breaks out and you buy it, make sure you have a stop that's just below rather, one of these higher lows. So there's still a lot of risk, and risk management is really what separates professionals from the amateurs. If you take a look at research in motion looks like maybe it's a little bit ahead of Google on the intraday time frames. Here in the daily time frame, what we see is that it held up a little bit better. By that I mean from the August lows to the recent high. In fact, it actually didn't. So I correct myself. It held up at that 50-day, not the 50-day, but the 50% retracement level. If you remember from that prior video, I said that that made sense. It was near par and this level of prior resistance that we saw in September. So it seems to be stabilizing just above 100. If we look at the hourly time frame, we saw the MACD divergence in here as well, where we saw lower lows in the stock, but a higher low in here. Now, the proper course of action is to look at an even shorter term time frame. And you look at how this 5-day moving average acted as resistance as it was declining. Now it's flattened out. Now it looks like the stock is potentially making that turn. So it's still risky in here because we've got a very damaged daily time frame. And looking at these longer term time frames, they're clearly extended. And when they get that extended, they can see exaggerated declines. So there are probably a lot of shorts in here that may get squeezed for a move higher, but I really think that these stocks ought to be looked at as trades to the upside. Now, those trades might be something that you can hold for a week or 2 weeks, or maybe they turn into investments, but it's up to the market to tell you how long to hold. And by that I mean, as long as it makes a series of higher lows, then you want to keep adjusting your stop underneath these higher lows. And which time frame you decide to do that upon is based on your own comfort level and how you look at risk and where, how much time you have to commit to the market, what your capital resources are, etc. Let's take a look at Apple now. Apple has not shown as much weakness just in the last few sessions. By that I mean it hasn't tested that low. That kind of concerns me a little bit. For it to bounce like it did here, pull back, hold along that 50-day moving average, and not test that. You want to see a retest of the lows a lot of times. It just assures that the early buyers in here kind of get shaken out and that the stronger holders are in there. And that creates a stronger base, basically, for the stock to continue to rally from. Looking at the Fibonacci, where did this stock pull back down to? Almost touched precisely. Let's just redraw that so I can clear that other stuff out. But from the August lows to the recent highs, almost precisely at that 50% retracement level. Okay, it dropped through the 50-day moving average, and again, that's why the 50-day moving average isn't a place to stick a bid in, but a place to start watching the stock. Now, it's very volatile in here. It's like dropping a ball out of the 15th floor of a building. Maybe it's going to drop to the 12th floor, bounce to the 12th floor. It's going to drop to earth again and bounce up to the 9th floor, and eventually the energy is going to dribble out of that ball, and then it's going to flatline. That's what happens with stocks a lot too. Is if they don't scare you out initially, they'll wear you out with the lower volatility that comes. Apple, I think the jury's still out in here. We're seeing these lower highs and higher lows. Basically, it seems more neutral than anything. Maybe above 170 we get some upward momentum, but breaking back below 160, I think you're in for a quick retest of these lows. It probably brings it down to maybe 145 or so, just to make sure that we flush those stubborn long holders that have bought in here. It's a very dangerous stock. I know a lot of people are emotionally attached to this stock. I know it from my emails. Saying that basically nothing can go wrong. It's Apple. They've got the most wonderful products, and I like their products too. But this stock chart, excuse me, on the monthly time frame, really does have me kind of nervous that if this stock really does fail, then there's a lot more trouble for this market overall. Finally, we'll look at Baidu because we looked at that one last time as well. And let's just begin with Fibonacci. And again, it's only to assign order to the markets. There's no magic science in my mind as to why Fibonacci seems to work in the market. It becomes, like a lot of technical analysis and like a lot of fundamental analysis, a self-reinforcing, or rather not self-reinforcing, in a way self-reinforcing, but a self-fulfilling prophecy that if enough people believe there'll be support there, they'll stop selling, which reduces supply. Another group of people start to believe there'll be support there, so they stick their bids in. It's an area where we can assign order to what appears to be chaos, and we get that potential for a change in the supply-demand dynamics and a potential turning point for the stock. That's all it really is. So it came down, touched that 50-day moving average, bounced strongly from there. Now we're retesting that area again, and you do see that it appears that the selling isn't as emotionally motivated with less volume in here and that diverging MACD, but it's not showing any signs of bouncing either. That 10-day moving average is still declining, rather the 5-day. And what I like to say is, as long as this 5 days moving average is declining, you don't want to trust the rallies. And that's what we had here. It got back above the 5-day moving average, but the direction of it was still lower, which a lot of times means that that rally will fail to hold, and that seems to be the case here. So that's the bullish scenario. Let's just real quickly say, well, what if this is a shoulder, this is a head, and what if this is another right shoulder? Well, this is why you've got to be very defensive. Now, the first break through this level, maybe it comes down to 280, rallies back up. This prior source of support then becomes resistance, and then you can look at this as far as a head and shoulders pattern. The height of that being 130 points, measured from the breakdown point at 300, that would give us a price objective of about 170, and that could bring it down near the 200-day moving average. The point is, I'm not trying to make predictions here. What you want to do is listen to the message of the market and determine what time frame are you trading on, and listen to those clues that the market gives as objectively as possible, and make sure you're aware of the risks and the potential rewards that are out there at all times.